1637, 1797, 1819, 37, 1901, 29, 1937, 1974, 1987. Jesus, didn't that fuck me up good? 92, 97, 2000, and whatever we want to call this.
I will be stunned if we don't have a recession in 23.
You went back to that day in 1942 because it was the day you purchased your first stock, which point out you were 11 years old then.
Right.
So
yeah, and the day I bought, I mean, the headlines.
The other side.
Yeah, the headlines were terrible every day. You know, everything was going badly. The Philippines were going to fall within 2 months. Things were grim in Europe. Our ships were being sunk, and the war was bad then. And that day that I bought, March 11th, the Dow Jones cracked 100 on the downside. There was a 2% decline, which would be 500 points today. And the night before, on March 10th, I said to my dad, I want to go all in. I had $125, and I put every bit of it in 3 shares of City Service Preferred, and which is still my personality, is to shove it all in.
As we've seen with Apple.
Yeah, somewhat. And as I pointed out to the crowd, I bought that stock at 38 and a quarter. It was down from 84 the year before, and it was down from 55 in January. And I thought, I'm really buying it cheap. So it went down to 27 after I bought it. And then and it went up to 200 later on, but I sold at 40.
Well, I would say that at any given point in history, including when stocks were their cheapest, you could find an equally impressive number of negative factors. I mean, you could have sat down in 1974 when stocks were screaming bargains. Could have written down all kinds of things that would have caused you to say, you know, the future is just going to be terrible. We really don't pay any attention to that sort of thing. I mean, we have, you might say that our underlying premise, and I think it's a pretty sound underlying premise, is that this country will do very well. And in particular, it will do well for business. Business has done very well. You know, the Dow went from 66 to 10,000 plus in the 100 years of the 20th century, and we had 2 world wars and nuclear bombs and flu epidemics, and you name it, Cold War. There's always problems in the future. There are always opportunities in the future, and in this country, the opportunities have won out over the problems over time, and I think they will continue to do so, absent weapons of mass destruction, which is another question. And business won't make much difference if anything really drastic happens along that line. So. you look at the record of the 20th century, you'd say, how could anybody have missed, in owning equities during that time? And yet, we had all kinds of people wiped out, in the 29-32 period. We had all kinds of things that were bad. But if you had just owned stocks right straight through, didn't leverage them, you'd have gotten a perfectly decent return. So we're unaffected, in essence, by the variables you mentioned. Just show us a good business tomorrow and we'll jump at the hook. I can't remember any discussions Charlie and I have had ever going back to 1959 that where we would have come to the conclusion at the end of them that we would have passed on a great business opportunity, a business to buy, because of external conditions. Nor did we ever buy anything that we thought was mediocre, simply because we thought that the world was going to be wonderful. It won't be the American economy, in my view, that does in investors over a 5 or 10 or 20 year period. It will be the investors themselves.
The bad years, the crisis years, the Dow dropped by about 50%. And since then it's, and people panicked and got out, of course, even in the mutual fund business, and particularly in the ETF business, a lot of net liquidations at the lows. And now we're back. I think the gain from that level is maybe 200%. So it shows you that when you act on the emotions of the marketplace, you're making a big mistake. I stay, and always have said, stay the course. Don't let these changes in the market, even the big one, that was the 50% decline. Don't let that change your mind. And never, never, never be in or out of the market. Always be in at a certain level. Buy and hold for a stock is one thing. Buy and hold the U.S. stock market is quite a different one. What do we have going for us in the U.S. stock market? Leaving aside how hard it is to pick the winners, how few people really ever heard of Amazon 25 years ago, to say nothing of Google, maybe a little more than that, maybe 30 years ago. So if you hold the stock market, you will, not to be corny, Bill, but you will grow with America. The correlation between the long-term growth of America's gross domestic product, so-called GDP, and the stock market is something like 95. But the annual correlation of those two things is probably 20. So, you're making a good long-term bet, but short-term betting is just not a good way to go.
Well, we've all been favored with the fruition, as it turns out today, of the ancient Chinese curse. May you live in interesting times. walk away from it, so deal with it we must. On that note, then, let me close with 5 simple principles, a few ideas of what you might want to think about, principles of investing that may help you. First, invest you must. The biggest risk is the long-term risk of not putting your money to work at a generous return, not the short-term, but nonetheless real risk of price volatility. Second, give yourself all the time you can. At the extremes, if you're in the 20s, begin to invest in stocks even if you've only got a little bit. If you're in the 60s, invest more in bonds and less in stocks. But always remember that compound interest is a miracle and time is your friend. Never think you know more than the market does. You're apt to be wrong if you do. Third, have rational expectations about future returns and be mentally prepared for market declines. Always remember, in good times and bad times alike, this too shall pass away. I spend a full page in my book on that sage piece of wisdom. If this too shall indeed pass away, and your emotions can kill you, you should keep them out of your investment program because impulse is your foe. Fourth, rely on simplicity. Simplicity above all. There are too many witch doctors in this business. Basic investing is simple. A sensible asset allocation to stocks, bonds, and reserves, a middle-of-the-road selection of diversified funds, a careful balancing of risks and returns, and lest we forget, costs, which can kill long-run returns too. Fifth and last, when you've followed all of these 4 rules, as I said, and I've meant 1,000 times, if not 10,000 times, no matter what happens, stay the course. Good luck in investing in these interesting times. Thank you.
And in the decade of the 80s, I think this is key. The decade of the 80s, this is what you hear from the press, this is what you hear from TV. In the decade of the 80s, the 500 largest companies eliminated 3 million jobs. 3 million jobs. But there was 2.1 million businesses started in the 1980s. And if they just have 10 people each, that's 21 million jobs. It's an incredible job machine we have in America. So that's what happened in the 80s. These 2.1 million businesses created all the jobs. And the decade of the 90s, the top 500 companies are going to eliminate another 3 million people. And all you ever hear about is Company X lays off 5,000 people in Hartford, and Company Y lays off 5,000 people in Rochester, and somebody doesn't buy a sofa in Scottsdale, Arizona, because they're reading their newspaper about another layoff in the Northeast. I mean, that's the nature. These companies have to do it to stay competitive. That's our business. Well, on the first one, and this is important whether you're investing for a 4-year-old, a 14-year-old, or a 74-year-old. You have to say, what am I going to do when the market goes down? Because I've had audiences like this, larger audiences, and I'll say, how many people in the room are short-term investors? I've never had anybody ever raise their hand. I mean, everybody in the world is a long-term investor until the market goes down. So I would say if you want to buy a small growth fund or you want to buy a balanced fund that's part bonds and part stocks, you put so much money in, put more in every year, you'll be very pleased in 10, 20, 30 years. Stocks will beat the hell out of money markets. They can beat the hell out of bonds. And the single most important thing to me in the stock market for anyone is to know what you own. I'm amazed how many people own stocks. They would not be able to tell you why they own it. They couldn't say in a minute or less why they own it. Actually, if you really press them down, they'd say the reason I own this is the sucker's going up. And that's the only reason. That's the only reason they own it. And if you can't explain, I'm serious, you can't explain to a 10-year-old in 2 minutes or less why you own a stock, you shouldn't own it. Stocks are not lottery tickets. There's a company behind every stock. If a company does well, the stock does well. It's not that complicated. People get too carried away. And first of all, they try and predict the stock market. That is a total waste of time. No one can predict the stock market. They try to predict interest rates. I mean, if anybody would predict interest rates right 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, it's very, I had logic, so I had a syllogism and studied these when I was at Boston College. There can't be that many people that can predict interest rates because there'd be lots of billionaires. And no one can predict the economy. I had a lot of people in this room were around in 1981 and 82 when we had a 20% prime rate with double-digit inflation, double-digit unemployment. I don't remember anybody telling me in 1981 about it. I didn't read, I studied all this stuff. I don't remember anybody telling me we're going to have the worst recession since the Depression. So what I'm trying to tell you, it'd be very useful to know what the stock market is going to do. It'd be terrific to know that the Dow Jones average a year from now would be X, that we're going to have a full-scale recession, or interest rates going to be 12%. That's useful stuff. You never know it, though. You just don't get to learn it. So I've always said, if you spend 14 minutes a year on economics, you've wasted 12 minutes. And I really believe that. Now, I have to be fair. I'm talking about economics in the broad scale, predicting the downturn for next year, or the upturn, or M1 and M2, 3B, and all these M's. I'm talking about economics. To me, is when you talk about scrap prices. When I own auto stocks, I want to know what's happening to used car prices. When used car prices are going up, it's a very good indicator. When I own hotel stocks, I want to know what hotel occupancy is about. When I own chemical stocks, I want to know what's happening to the price of ethylene. These are facts. If aluminum inventories go down 5 straight months, that's relevant. I can deal with that. Home affordability, I want to know about when I own Fannie Mae or I own a housing stock. These are facts. They're economic facts and there's economic predictions. And economic predictions are a total waste. And interest rates, Alan Greenspan's a very honest guy. He would tell you that he can't predict interest rates. He could tell you what short rates are going to do in the next 6 months. Try and stick him on what the long-term rate will be 3 years from now. He'll say, I don't have any idea. So how are you, the investor, supposed to predict interest rates if the head of the Federal Reserve can't do it? But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens. If you like a stock at 14 and it goes to 6, that's great. You understand the company, you look at the balance sheet and they're doing fine, and you're hoping to get to 22 with it. 14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen. No one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times. And so you can take advantage of the volatility in the market if you understand what you own. Another key element is that you have plenty of time. People are in an unbelievable rush to buy a stock. I'll give you an example of a well-known company. Walmart went public in October of 1970. 1970 went public. Already had a great record. It had 15 years performance, great balance sheet. You could have waited 10 years saying you're a very conservative investor, you're not sure this Walmart can make it. You want to check, you see them operate in small towns, you're afraid they can only make it in 7 or 8 states, you want to wait till they go to more states, you keep waiting. You could have bought Walmart 10 years after they went public and made 35 times your money. If you bought it when they went public, you would have made 500 times your money, but you could have waited 10 years after Walmart went public and made over 30 times your money. Again, I'm repeating myself, stocks are not a lottery ticket. There's a company behind every stock. And you can just watch it. You have plenty of time. People are in an amazing rush to purchase a security. They're out of breath when they call up. You don't need to do this. It's the important thing is you can't get too attached to a stock. You have to understand there's a company behind it. You can't treat this like your grandchildren. No, you have to deal with the stock and say, I understand the company, and if it deteriorates, if the fundamentals slip, you have to say goodbye to it. If one rule you want to remember is, the stock does not know you own it. This is a breakthrough. And then I want to conclude with, there's always something to worry about. If you own stocks, there's always something to worry about. You can't get away from it. What happens in the 50s, people were worried about, the only reason we got out of the Depression was World War II. We got another recession. In the early 50s, they said we're going to go right back into a depression. People were worried about a depression in the 50s, and they were worried about nuclear war. So there's always something to worry about, and the key organ in your body in the stock market is your stomach. It's not the brain. If you can add 8 and 8 and get reasonably close to 16, that's the only level of math you need to know. You don't know to need the area under the curve. Remember that quadratic equation and an integral calculus and the area under the curve? I mean, whoever cared what was under the damn curve? I mean, you know, but you had to study this. You don't need this in the stock market. So all you have to know is you're going to see, it's always going to be scary. There's going to be always something to worry about. And you just have to forget all about it. Cut it all out and own good companies or own turnarounds. Study them and you'll do well. And that's all there is. And I'm ready for questions.
wise to kind of like prepare for the worst, hope for the best, prepare for the worst. Don't get too adventurous. Like watch out for margin debt. Like I would really advise people to not have margin debt in a volatile stock market. And you know, from a cash standpoint, keep powder dry. You can get some pretty extreme things happening in a down market. Like Brett Johnson, who was a CFO, who is a CFO of SpaceX, was at Broadcom in 2000, and he said that, and that's a good company making good products. And he said from peak to trough, I think in less than 12 months, Broadcom went down 97%. So, like, even if you had a small margin loan there, you got crushed. It subsequently recovered, and I think, you know, to much higher levels. But you know, if there's like mass panic in the stock market, then you got to really be careful about margin debt. As we know, the economy is cyclic, so and we're somewhat overdue for a recession. And my best guess is that, you know, we have sort of stormy times for a year to a year and a half, and then things start to, dawn breaks roughly in Q2 24, if I were to get, that's like my best guess. Recessions don't, like booms don't last forever, but neither do recessions.